So let's just set the scene here. April 29th, 2026, Jerome Powell was supposed to just, quietly pass the baton.
Right, the standard polite farewell.
Exactly. He was slated to step down, give his little speech, and just let the incoming administration install their people at the Federal Reserve.
But like they've always done.
Yeah, but instead, he essentially ignites this historic 8-4 institutional fracture. I mean, he openly defied the executive branch.
He completely dug his heels in.
Right, refusing to leave his seat on the Board of Governors. So the whole consensus of global finance didn't just crack, it literally shattered on live television.
It really is the kind of institutional earthquake we just haven't seen in decades. I mean, the baseline assumption for, the last 40 years has been that the central bank operates totally above the political fray.
Right, this unified, impenetrable front.
Exactly. And what we watched on April 29th was the complete collapse of that facade. We're looking at a fundamental regime change in how the United States manages the cost of money.
And to map out exactly what this regime change looks like for you, the listener, we are pulling from a massive stack of analysis today.
A really heavy stack.
Yeah, no kidding. We've got the immediate breaking news from Reuters and the Associated Press. We're looking at the foreign exchange volatility models from Binance and forex.com.
Which are flashing all sorts of warning signs right now.
Oh, absolutely. Red alerts everywhere. Plus, we are heavily leaning on some incredibly dense macro-level institutional white papers that just dropped from BNP Paribas and Janus Henderson.
They did some fantastic deep modeling on this.
They really did.
Yeah.
So our mission today is to cut through all that heavy financial jargon, right? We want to figure out exactly what this unprecedented Federal Reserve meeting actually means for you.
Because it does impact you directly.
Oh, totally. Whether you're prepping for a corporate board meeting or you're just trying to figure out why your grocery and gas bills are skyrocketing, we're going to unpack the soaring cost of living, this crazy two-pope scenario at the Fed, and the incoming Warsh doctrine that's basically about to rewrite the rules of money.
Because the decisions made in that room, they dictate the global cost of credit. I mean, every corporate expansion plan, every single mortgage application.
Your credit card rates.
Yeah, exactly. The baseline valuation of every major asset class is currently being repriced based on these fractures we just witnessed.
So let's jump straight into the big macro picture here. The Fed is essentially suffocating in this trap right now.
A squeeze on two fronts.
Right. So the Federal Open Market Committee, the FOMC, they decided to go with a hawkish hold. They kept the benchmark interest rate totally steady at that 3.5% to 3.75% range.
Which, on its face, seems cautious.
Yeah, but then you look at the labor data and you see an engine that is clearly stalling out. I mean, unemployment has ticked up to 4.3%.
And we're seeing this widespread adoption of what they call a low-fire strategy across all these major sectors.
Right, so companies aren't doing mass layoffs yet, but they have absolutely frozen headcounts. No one is hiring.
Well, the labor hoarding phenomenon is a classic late-cycle indicator. I mean, executives remember how brutally difficult and expensive it was to rehire talent after the 2020 disruption.
Oh, yeah, the Great Resignation, all of that.
Exactly. So they are terrified of letting people go. Instead, they're just bleeding payrolls through natural attrition. Like, if someone quits, they just don't replace them.
Right. But the truly alarming metric here, from the sources, is the discouraged worker data. We have 510,000 workers who have completely dropped out of the labor force.
Just entirely abandoned their job searches.
Right, which means they don't even count in the main unemployment bucket anymore.
Exactly. And when you combine that with the 1.8 million long-term unemployed, and by that I mean the people jobless for 27 weeks or more.
Wow. Over 6 months.
Yeah, which represents over a quarter of all unemployed individuals. You're seeing a structural decay in labor mobility. I mean, sure, the headline number shows 178,000 jobs added in March.
Bouncing back from that February contraction.
Right, but the internals of that data reveal a market that is just barely treading water.
So here is the massive tension. Under a normal policy framework, if the labor market was flashing those kinds of stagnation signals, you'd immediately see a dovish pivot. Right?
Oh, absolutely. They'd usually rush to help.
Yeah, the Fed would start aggressively cutting that 3.5% rate to inject liquidity and get people hiring again. But they can't. They are completely paralyzed by the inflation data.
Because inflation is incredibly sticky right now.
Right. Year-over-year CPI just surged back up to 3.3% in March. Core CPI is sitting at 2.6%. They are miles away from their 2% target.
And the trajectory has completely reversed on them.
Right. So why hold rates when the job market is slowing? because of this sticky inflation. And the sources are very clear on the crucial driver here. It's geopolitics.
It's totally exogenous. This isn't about, excess consumer cash chasing too few goods like we saw a few years ago.
Right. It's not stimulus checks this time.
Exactly. This is a supply-side shock. Geopolitics has completely hijacked monetary policy. I mean, the war in Iran and the sustained blockade of the Strait of Hormuz.
Yeah, which is a massive bottleneck.
It's huge. It has trapped a massive percentage of global seaborne crude oil. So we're looking at global oil prices hovering dangerously close to $120 a barrel.
And see, $120 oil isn't just a problem when you go to fill up your car. It acts like an aggressive, regressive tax on the entire global supply chain.
It touches absolutely everything.
Right. When maritime fuel costs quadruple because these massive tankers are taking crazy detours to avoid the blockade.
And insurance premiums on those vessels are skyrocketing.
Exactly. Every single physical good becomes more expensive to move. The sources show we are seeing airline fares up 14.9%. We're even seeing hospital services up 6.4%.
Well, yeah, because the energy intensity of running those massive hospital facilities has spiked. That is the really insidious nature of energy shocks.
Because they bleed into everything.
Exactly. They start in the commodities market and rapidly embed themselves into the service sector. The Fed's internal models actually show that when energy costs remain elevated for more than 2 consecutive quarters, businesses just abandon their forward pricing models.
Meaning they stop eating the cost.
Right. They start passing those costs directly to the consumer in real time. So the central bank is staring at an economy where growth is decelerating, but price pressures are accelerating.
Which is literally the textbook definition of stagflation.
Exactly.
I was thinking about this, and I look at this dynamic like a car driving up a really steep hill, but the parking brake is permanently stuck.
Oh, that's a good way to look at it.
Right. So gravity's pulling the car backward. That's the steep hill of the softening labor market. The 510,000 discouraged workers just giving up.
Yeah, the momentum is dying.
Exactly. So the driver desperately needs to release that parking brake, which is the 3.5% interest rate, to get the wheels moving again.
But they can't.
They can't, because the engine is already running at 7,000 RPMs and is completely overheating from this $120 oil shock. If the Fed drops rates now to save the job market, they blow the engine and spark a secondary inflation crisis.
A crisis that could take a decade to extinguish. And the margin for error here is basically non-existent because the American consumer is already totally tapped out.
Yeah, the Janus Henderson modeling on this is grim.
It really is. The dual shock hitting household balance sheets right now is historically severe. We aren't just dealing with gasoline being up almost 19% year over year.
Right, 18.9% to be exact.
Yeah, we are simultaneously absorbing the impact of an 11% effective tariff rate across imported goods.
Which, by the way, is the highest effective tariff rate on the American consumer since 1943.
It's staggering.
It is. When you compound that massive protectionist trade policy with this energy crisis, the sources show the average American family has taken a $1,500 hit to their purchasing power in 2026 alone.
That is just money vaporized from the consumer economy.
Right. It's not going to restaurants. It's not going to streaming subscriptions. It's going strictly to covering the friction costs of deglobalization and this geopolitical conflict.
But let me push back for a second here.
Sure.
Isn't a gas price spike usually just temporary? I mean, eventually supply chains reroute. Why would the Fed alter its entire long-term structural strategy over a geopolitical bottleneck? Well, because they no longer believe it's temporary. And you can see this in a subtle but massive shift in the Fed's official language.
Oh, right. The BNP Paribas paper pointed this out.
Exactly. It's a singular, chilling alteration in the April 29th release. For months, the Fed has characterized inflation as somewhat elevated.
They always use that qualifier.
Right, somewhat. They relied on that to signal to the markets that they viewed the price spikes as manageable, transitory. But in this new statement, the word somewhat was completely scrubbed.
Gone.
Gone. They simply branded inflation as elevated.
I mean, in central bank speak, that's like sounding the alarm. Removing that one single modifier changes the entire forward-looking trajectory of their policy.
Precisely. Jerome Powell was forced to concede in his press conference that short-term inflation is making the outlook highly uncertain.
So they are officially abandoning the narrative that this is just a temporary blip.
Exactly. They are acknowledging that this $120 oil shock and the new structural tariff regime are creating a persistent, sticky inflation environment. It's embedding itself into the broader economy, and it cannot be solved with minor policy tweaks.
So going back to the analogy, the cooling system on the car has totally failed.
Yes, and the mechanics in the boardroom are violently disagreeing on how to fix it.
Which brings us perfectly to the actual floor vote. Because, I mean, that disagreement didn't just stay behind closed doors. We saw an 8-4 fracture on this monetary policy decision.
Which is huge.
Yeah. To put that in perspective for you, an 8-4 split represents the highest level of public dissent at the Fed since October of 1992.
It shatters decades of precedent.
Right. Usually the FOMC acts like this perfectly synchronized swimming team. Now it looks like a bar brawl.
Well, the modern Federal Reserve has really weaponized unanimous voting as a tool of market stabilization.
Right, to project confidence.
Exactly. The assumption has always been that vigorous, sometimes hostile debate happens in the closed-door sessions. But once those doors open, everyone falls in line. A single dissenting vote is rare. 4 dissenting votes is a full-blown mutiny.
So let's break down these factions impartially, because what makes this fracture so crazy is that the 4 dissenters didn't even agree with each other.
Right. It was a trimodal distribution of policy preference.
Yeah. So you have the majority block of 8 who voted to hold the line, but then you have this highly organized, hawkish trio that defected.
And we're talking about 3 regional Fed presidents here.
Right. Beth Hammack from Cleveland, Neil Kashkari from Minneapolis, and Lori Logan from Dallas. Now, these 3 actually agreed with holding the rate at 3.5% to 3.75%. They didn't vote to hike rates.
No, but they voted against the overall policy statement.
Because of one specific word. They wanted to eliminate what's called the easing bias.
Right. The statement included a hint about the extent and timing of further adjustments. In central banking, that's an easing bias. It's basically a structural promise to the bond market that the next move will inevitably be a rate cut.
But they just don't know exactly when.
Exactly. But Hammack, Kashkari, and Logan, they looked at the sticky inflation, the $120 oil, and concluded that offering the market an easing bias was institutional malpractice. They are deeply concerned about inflation.
So they wanted to strip the word further from the statement entirely. They wanted the Fed to retain the option to hike rates again if things spiral. And it makes so much sense when you look at their specific regions.
The geography plays a huge role.
Totally. Cleveland is heavily exposed to industrial manufacturing, which gets decimated by high energy costs. Dallas is the epicenter of the American energy sector, so they're watching this massive influx of capital from $120 crude, knowing it's going to cause an inflationary tidal wave.
And Minneapolis is highly sensitive to agricultural commodity inflation. Their local economies are basically screaming that inflation is not conquered.
Right. But then on the exact opposite end of the spectrum, you have the 4th dissenter, the dovish outlier.
Governor Stephen Miron.
Right. His dissent is structurally inverted from the hawkish trio. He was appointed by the Trump administration, and he dissented because he wanted an immediate 25 basis point rate cut.
He is pointing directly at the halted hiring market and those 510,000 discouraged workers.
Yeah. He thinks the 3.5% rate is unnecessarily punitive.
It perfectly encapsulates the dual mandate that's tearing the institution apart right now. You have 3 regional presidents screaming about price stability and 1 Washington governor screaming about employment.
Which historically is a classic dynamic.
Oh, absolutely. It's the historical town versus gown divide.
I love that term. The sources note that if you look at the historical data, regional Fed presidents, the town, historically dissent for tighter policy 75% of the time to protect Main Street prices.
While Washington governors, the gown, lean toward easier policy 60% of the time to protect employment.
So Miran is playing exactly to type. Now, the sources compare this 2026 fracture to the ghosts of 1992. But it seems vastly different. In 92, that 8-4 split happened during the currency crisis.
Right, Black Wednesday and George Soros breaking the pound.
Yeah, but that 1992 split was mostly a technical disagreement over the M2 money supply, right?
Exactly. They were arguing over the dials and levers of a machine they fundamentally agreed on how to operate. The 2026 fracture is highly strategic and deeply political.
So let me ask you this. Does this level of public infighting destroy the market's confidence in the Fed?
Well, it destroys the premium of certainty, sure, but there is a strong argument that this transparency is actually vital right now.
How so?
Hidden dissent has always existed. If you read the old transcripts from the Greenspan or Bernanke eras, the internal debates were vicious. They just suppressed them during the formal vote to protect the illusion of control.
They wanted to look infallible.
Exactly. Bringing that dissent into the formal public vote signals to the markets that a genuine regime change is underway. It forces Wall Street to realize the Fed doesn't have a flawless crystal ball.
So the era of hand-holding is over.
Yes.
Wow. Yeah. Okay, but this internal fracturing over policy is merely a reflection of the intense external pressure the institution is facing from the White House.
Which culminates in this jaw-dropping leadership showdown.
The two popes scenario.
Ah.
So Jerome Powell announced he's stepping down his chair on May 15th, but he's doing something no former chair has done since Mariner Eccles in 1948.
He is refusing to leave the Board of Governors.
Right. His separate term as a governor actually lasts until 2028. And we need to unpack the political context here with strict neutrality, just looking at what the sources report.
Of course.
The Trump administration, via the Department of Justice and Jeanine Pirro, launched a criminal investigation into the Federal Reserve's building renovations.
Right, the procurement processes.
Yeah. And Powell views this as an unprecedented attack on the Fed's 113-year independence. Now, even though the DOJ paused the probe, they stated they wouldn't hesitate to resume it.
They left the threat hanging right over the institution.
Exactly. So Powell explicitly stated in his press conference that he has no choice but to stay to ensure the investigation concludes with transparency. He vowed to prevent the Fed from becoming a political entity.
He recognizes that if a chairman resigns under the threat of a paused DOJ investigation, it establishes a terrifying precedent.
Yeah, it tells any future administration that if you don't like interest rates, just launch a probe into the chairman's staff until they quit.
Exactly. So by staying, the sources warn of a parallel power center being created, a two popes scenario.
Right. You have Powell, who has deep loyalty among the Fed staff and the regional presidents. He's one pope.
And then a new chair is coming in to enact the administration's preferred policies, the second pope.
So let me play devil's advocate here. Powell says, I will never be a shadow chairman, and he wants to keep a low profile. But by stubbornly staying to block the president from filling his seat, hasn't he inherently politicized the board anyway? Doesn't this create the exact dysfunction he claims to be fighting?
That is the immense calculated risk he is taking. Powell is acting as an institutional backstop. He is essentially choosing internal friction over what he perceives as institutional capture.
He's choosing the lesser of two evils, in his mind.
Exactly. He's ensuring the incoming chair cannot easily implement a completely partisan agenda. If the market believes the Fed has lost its independence, bond yields will violently spike anyway, so he's taking a stand.
Right. So if Powell is the outgoing pope, holding his ground in the Vatican, who is stepping in, that brings us to Kevin Warsh.
And a radically new economic philosophy.
Yeah, the Senate Banking Committee just advanced Kevin Warsh to be the next Fed chair in a tight 13-11 party line vote.
Full Senate confirmation is imminent.
Right. And Janus Henderson analysts have dubbed his philosophy the Warsh Doctrine, which is basically a regime change at the Fed. So let's break this doctrine down. First, he believes the Fed has suffered from mission creep and monetary dominance.
He argues the Fed has transitioned from being a referee into the primary engine of the American economy.
He wants a strictly narrowed mandate, focusing only on price stability and employment. He specifically wants to strip away peripheral issues like climate change from the Fed's purview.
He wants them back in their technocratic lane.
Exactly. But the most fascinating part of his doctrine, the speculation here, is his theory on the AI productivity miracle.
This is the cornerstone of his macroeconomic outlook.
Yeah, Warsh believes artificial intelligence will create a massive vertical surge in workforce productivity.
And to understand why a central banker cares about tech productivity, you have to look at how economic growth works. Usually, if the economy grows fast, wages get bid up, production costs rise, and that triggers inflation.
Right, and the Fed has to raise rates to cool it down.
Exactly. But Warsh argues AI breaks that correlation. If AI allows a worker to be 30% or 50% more efficient, output expands massively without increasing the cost of labor. You get growth without the inflationary overheating.
I was thinking about this like updating an old smartphone's operating system.
Okay, how so?
So if you download a new OS, which is AI, and it makes the phone run 20% faster and more efficiently, you can actually lower the internal cooling fan, which would be interest rates, without overheating the battery and causing inflation.
That's a great analogy. It's a massive supply-side expansion. And it's actually a direct callback to Alan Greenspan in the late 1990s during the internet boom. Greenspan kept rates relatively low, betting the internet would allow faster growth without inflation. And he was right.
So Warsh is placing the exact same bet on AI.
Yes.
But his structural changes are where things get really intense. He wants to abandon forward guidance. He wants to permanently kill the dot plot.
Right, the dot plot, which is that chart where FOMC members project exactly where they think rates will be in the future.
Wall Street obsesses over those dots.
They do. But Warsh argues it creates moral hazard. He wants to return to an opaque, meeting-by-meeting, strictly data-driven approach.
He also wants rapid quantitative tightening, or QT, to drastically shrink the Fed's balance sheet. He believes the massive bond-buying programs artificially inflated Wall Street at the expense of Main Street.
He wants to drain that excess liquidity out of the banking system.
But wait, what happens if Warsh removes forward guidance? I mean, if the Fed stops telling the market what it's going to do, won't Wall Street have a massive panic attack every time a new jobs report drops?
Oh, absolutely. The analysts confirm that, yes, the era of handholding is over. Markets will have to learn to fly without verbal guardrails.
Which guarantees a massive spike in rate volatility.
Yes, but Warsh is fully willing to accept short-term market chaos to restore long-term structural health. He wants to break the market's addiction to central bank intervention.
But we don't even have to wait for Warsh to take over to see that chaos, because the markets are already having a visceral reaction to this 8-for-4 split and the looming regime change.
The tremors are already here.
Let's talk about those market tremors. Post-meeting, the financial markets reacted violently to the hawkish hold. The 10-year Treasury yield, which dictates mortgage rates and corporate debt, hit 4.40%.
Which is a one-month high.
Right. And the 2-year yield spiked dramatically. But the really wild stuff is happening in foreign exchange. The U.S. dollar index, the DXY, is testing the 99 resistance level.
And USD-JPY broke the critical 160 level.
Right, meaning the Japanese yen is historically weak against the dollar.
Which puts the Bank of Japan on high alert for currency intervention.
And this is where it gets crazy. To prop up the yen, Japan has to buy yen, which means they need U.S. dollars. How do they get dollars? They dump U.S. treasuries onto the open market.
Exactly. When the largest foreign buyer of U.S. debt starts dumping bonds, the price of U.S. treasuries plummets and yields shoot even higher.
It's like a shadow rate hike on the U.S. economy. Meanwhile, major institutions are getting totally spooked. Goldman Sachs just reset its U.S. recession probability to 30%.
They're citing the oil shocks, fading fiscal support, and labor fatigue.
So bringing all this high-level finance directly down to the listener's daily life. A 30% chance of recession, skyrocketing bond yields, and $120 oil means that borrowing costs for mortgages, credit cards, and auto loans are not dropping anytime soon.
Not at all.
You need to brace for a period where credit is tight and everyday goods remain incredibly expensive due to the tariff and the energy squeeze. So, practical question for the listener.
Shoot.
If the smartest economists in the room, the actual FOMC members, are splitting 8-4 because they can't agree on where the economy is going, how is a regular person supposed to plan their financial future right now?
In a high-volatility regime change environment like this, the best strategy is resilience over prediction.
Meaning what exactly?
Don't bet on immediate rate cuts to bail out bad debt. Acknowledge that the cost of capital has fundamentally reset. If you have variable rate debt, you need to deleverage. If you're managing a business, you need to lock in fixed-rate debt now, even at these elevated levels.
Because the volatility introduced by Warsh could send yields spiraling even higher.
Exactly. The era of easy, predictable money has ended.
Wow. Okay, let's do a rapid-fire recap of the journey we just took.
We covered a lot of ground.
We really did. We are living through the highest economic squeeze in decades. The Fed has suffered a historic 8-4 fracture. Jerome Powell is making an unprecedented institutional stand, refusing to leave his seat.
Creating that two popes dynamic.
Right. And Kevin Warsh is stepping in, bringing a radical AI-driven, guardrail-free philosophy to the global economy. But I want to leave you, the listener, with one final provocative thought that builds on everything we've talked about.
Okay.
So Kevin Warsh wants to aggressively shrink the Fed's balance sheet by selling off government bonds, right, to correct market distortions.
Yes, rapid quantitative tightening.
But with the U.S. national debt soaring and deficits running incredibly high, the Treasury is flooding the market with new bonds. So if the Federal Reserve steps away as the buyer of last resort, who exactly is going to buy all that American debt?
Japan is dumping it. China is unwinding it.
Exactly. And if domestic buyers have to absorb all of it, at what extreme punishing interest rate will the United States government be forced to borrow?
It's a multi-trillion-dollar question.
It really is. Thank you for joining us on this deep dive into the forces shaping your world. Keep questioning the headlines, stay resilient, and we'll see you on the next one.